So one of the most famous value investments of all time was Warren Buffett's purchase of Apple. It was first disclosed that he bought shares in the first quarter of 2016. So what I wanted to do was use our methods that we use to value stocks, go through our exercise, but pretend like we're back in the first quarter of 2016, meaning we only have access to Apple's financial data from, let's say, 2005 to 2015. And then say, would we have bought it whenever Warren did? And if the answer is no, try to figure out why, because it was obviously the right decision. All right, so let's get started. First up is going to be the income statement. So if this is your first video watching, let me orient you a little bit. So I have the outline on the left-hand side of my screen over there. And that's just going to be what we run through in each of the balance sheet, income statement, cash flow statement, and then finally end with valuation. Calculator up top. And then usually I have some info about the stock in the top right of the screen that we're going over. But in this case, I want to keep the price that it was selling at the time a secret, because I think that could lead to some hindsight bias. I mean, I already know it. So that's going to be there, the hindsight bias. And that's where my quote's up top. As far as the financial statements, what we're looking at is every quarterly result going from the first quarter 2005 to the last quarter of 2015. So 10 years of financial data on Apple. Okay, and we're going to see, would we have bought this stock whenever Warren did? All right, let's go. First up is total revenue. So what's one thing we like to see here? Growing. I mean, hell yeah, it's growing. That's awesome. All right. That's usually all we look at there. We don't get a metric there. I think price to sales is kind of a cheap thing to look at. Not cheap it's just not very good. It doesn't really tell you that much about a business to just judge price to sales. All right, we'll look at gross margin, because this is one of Warren Buffett's favorite. You know, it's a sign if a company has a competitive advantage, because, you know, if they can maintain a steady gross margin or raise their gross margins, it means that the customer is willing to pay a premium for their products. They're able to charge a lot more than just their raw materials. And 40% is a pretty solid gross margin, especially in the products business. So I could see that getting a check. Another thing Warren Buffett would look at, according to the book Warren Buffett and the Interpretation of Financial Statements, is research and development as a percentage of gross profit. So you make a profit, how much of that is being spent putting back into the business in research and development, especially for what he would see as a technology company or a product company. If somebody's having to put a lot of money back into R&D, you'd be kind of suspicious, or not suspicious, but you'd say, man, they're having to always reinvest to keep their edge. I think one company that comes to mind is Intel. It's one of the things that I don't like about the stock, even though I did buy some a little ways back. They have a high R&D because they have to always be researching new ways to stay ahead of their competitors as far as chips go. Apple is actually pretty low. I mean, look at this. Only 8% of their gross profit at the time, remember this is historical, was going to R&D. All right. So that would be a green as well. Next up, we're going to try to see how much debt they're in. And the way that we're going to do that is we're going to look at interest as a percentage of operating income. So one thing, Yahoo Finance did not have their interest expenses going to 2013. It really only started picking up in, the second quarter of 2013. So keep that in mind. But anyway, look at this percentage. I mean, only 1% of their operating income is going to interest, 1 to 2%. So that's outstanding. That's the sign of a company that's really not in a lot of debt at all. So that's something Warren Buffett would also really like, and it's something I like too. All right, so let's see. Next up is going to be pre-tax income. You'll see once we get to the valuation section that this is one of the ways that we judge a company, because it's a great way to compare apples to apples. You know, the tax rates can change. Different presidents can come in, lower tax rates, raise tax rates. But if you look at pre-tax income, you can get a really good judge of how a company's doing over time. So let's see. What I'm going to do here is just take the average of the last four quarters, or not the average, I'm going to total the last 4 quarters and get $18 billion a quarter in pre-tax income. So let me write that over here in the outline, $18 billion. All right, and now our growth rate. Okay, so how do we do growth? We're going to go like over a 5-year period. So probably, let's say over here, about 2010, 2011. So this was 2011. They were around 15. And now they're at 18. So this is a crude calculation, and I like to be conservative here because I think that whenever you're valuing growth on a company, you want to be super conservative because you could lead to like really high overvaluations. So let's say they went from, they had $18 billion now, they were at 15, and they did that in 4 years. So to get an annualized growth rate, you raise that to the 1/4 because 4 years. And you get a growth rate of 1.046%, or, 4.6%. So I'm going to round up and just say 5%. All right. Sweet. All right. So last on the income statement is going to be earnings per share. We're always using diluted earnings per share. And this is going into another valuation calculation. So I'm going to be, super conservative and quick here. I'm just going to take the average of like the last, let's say, 12 quarters. The average of the last 3 years, 12 quarters, they were earning 47 cents a quarter in income. So 0.47 times 4 is $1.88 per share average over the last 3 years. All right, that's it for the income statement. Let's go through the balance sheet. All right, so one thing I like to look at, and I learned this from listening to Warren Buffett and reading everything I could about him, is total tangible assets. And not just total tangible assets in a vacuum, but looking at return on those assets. Because I've talked about this before. Return on tangible assets, let me pull up return on tangible assets, is a great way to measure the company's, like, how good management is at allocating capital. Because why do you buy assets? You buy assets so that they can make you more money. So return on tangible assets, I mean, tangible is just so that you don't wind up counting, intangible assets. But return on tangible assets tells you how well your assets are performing. It's like an efficiency rating for the company. I've said this before, but it would be the same exact question you'd ask yourself if you were starting a business. You would say, how many assets am I going to buy? And then what is going to be my pre-tax income from those assets? And that would, in your head, that would be what you use to figure out if it was a good business decision. So this is just that philosophy applied to stocks, okay? And we do pre-tax just because, like I said, it's apples to apples. You can kind of think about that return on a pre-tax basis compared to other opportunity costs. All right, so this is outstanding. Let me fit a trend line here just so that I can see it a little bit better, because quarters are jumping all around. All right, so yeah, pre-tax return on tangible assets is over 30%. That's awesome. That's a sign that management has been allocating capital great. And just think about it like this. I mean, how would you like to buy a business for $100,000 that's going to pay you $30,000 pre-tax on those assets? That's how much the assets are going to make. I mean, that's exactly what's going on here. So it's pretty awesome. That gets a green, and it's even better, and this is something Warren Buffett has said too, it's even better whenever your total assets are growing. So if I pull up total tangible assets again, you can see they're growing. So total assets are good. I mean, return on tangible assets is good, but return on tangible assets on a growing asset base is even better, because if you think about it, if your return on tangible assets is flat and your assets are growing, it means that you're making enough money to keep up with your growing assets. All right, I know that's a lot on total tangible assets. Let me go on. Let's see, tangible book value. So tangible book value is all of your assets minus all your liabilities, and then you also subtract out intangible assets and goodwill. So what makes this a great metric too is that it's like the net worth of the company. It's like the liquidation value. So this is something that is super important to look at, and you want to make sure it's growing. So this could spook some people that, you were growing and now you're kind of flat, if not shrinking. So even though you're making money, you're not really showing up in the company's tangible book value. So that's kind of confusing. But what you want to look at in this case is your tangible book value per share, because what's going on is that the company could be buying back shares, so that even though their total tangible book value is the same, since they're buying back shares, they're decreasing the number of shares. So whenever you divide something by a smaller number, it should be going up. So yeah, okay. So the tangible book value per share, even though the total tangible book value is steady, the tangible book value per share is going up. And this is great. So this is the net worth of the company is rising. All right. We could do return on tangible equity here. For the sake of time, I'm not going to do it. All right, and then last, we're going to look at number of shares, see if management is buying back shares, which they should be. Yeah, so this makes sense. Remember, we said that, it makes sense mathematically because the tangible book value has a different appearance to it than the tangible book value per share. And look at the share repurchase, man. This is awesome. So they had a real change of operating philosophy at this time. And I bet you Warren Buffett loved this, huh? Because his philosophy is that share repurchases are a good idea for two reasons. If it's at a discount, the share price is at a discount, if management thinks it's at a discount, and if it's at more of a discount than they think that they could make with the money investing into their business. So share repurchases, whenever you're making return on tangible assets over 30%, that's a huge bull sign, in my opinion. That shows that management is like, look, we know we can invest, we can buy other assets, we can continue to grow and continue to get 30% on those assets. We think buying back our stock is a better place to put the money than that. So, like I said, big green flags, or, whatever you want to call it, bull signs All right, that's it for that. Let's go to the cash flow statement. All right, as far as the cash flow statement goes, we're going to go fast here. We're going to look at free cash flow, capex, and depreciation. So free cash flow is your cash from operations minus your capital expenditures. So it's just another way to kind of check your income and make sure that they're similar. You know, if they're different, you need to start really asking questions and diving in, but you want to make sure it's following kind of the similar pattern as your income. All right, so in this case, it looks about the same. I'm going to fit a trend line like I did earlier. Let's see. Yeah, we're at what is this? $16 billion a quarter. Okay, so what? 16 times 4 is what? 64. So the free cash flow, I'm going to put $64 billion. I just realized my pre-tax income, I never multiplied that by 4. So I need to multiply 18 times 4. It's actually 72, not 18. So let me change that. All right, 72. Let's just do a quick look at capex and depreciation. So we're going to look at depreciation first. And depreciation just shows you on paper how much the assets are losing value. And look at this. It's $3 billion a quarter about. And then you compare that to capex. And I would assume because free cash flow is lower than pre-tax income, you would assume that the capex would be higher than this. So let's see. Yeah, $4 billion. This isn't significant. If you think about it, you're doing $4 billion a quarter in capital expenditures on income of $72 billion a year. So one thing that apparently Warren Buffett likes to look at is your capex as a percentage of your pre-tax income. So what you would do is you would say 4 times 4, so $16 billion divided by 72, so 22%. So what he's looking at is making sure that even if you're making money, you're not having to spend all that cash to just do capital expenditures. This case, it's not a big deal. It's not outstanding, like it's not super low like some of the other companies he owned that just aren't manufacturing companies or product companies. But anyway, it's not terrible. All right, let's go to valuation. That's what we've all been waiting for, right? All right, the first one we're going to do is a rule of thumb method that I use that, like I said, has been really good to me and is just pretty simple. 72, which is our pre-tax income, times 10, and then divide by the number of shares, which was 22 billion. That's up there in the top right of my screen. All right, and I get, at the time, a price target of $33 a share. One thing I want to stress here, and it's the reason I like this pre-tax income one so much, is that I think the most important part of a due diligence is done in the first 3 sections of this video. I think the valuation should be just like a super easy calculation. You shouldn't try to like get your discounted cash flow down to like the 3rd decimal point or something like that. Just get a ballpark and know, is it undervalued or not? And then if it's got all these other green flags, then you know it's a buy, right? Okay, so let's do this one. I just put this formula on there because this formula came from the Intelligent Investor book. It's a Ben Graham formula. I don't really use it in my own investment, but I like having a formula. Okay, so let's see. Earnings per share, 188 times 8.5 plus 2 times our growth rate, which was what, 5%. All right, and we get $35 a share. That's funny how that works out like that, huh? And then lastly, our discounted cash flow. I have a video about doing a DCF that you can check out on my channel, but it's running in the background of this screen. And what we're going to output is what we think the market cap is. All right, so free cash flow, we said $64 billion. Perpetual growth rate, I'm going to say less than the growth rate that we used in the earnings per share. So if we use 5% there, I'm going to say 4% perpetual growth. And discount rate, 15%. All right. And I get 669 divided by 22. I get $30 a share. This one really, that's 39. I get $30 a share. Okay, so this one is really dependent on your discount rate. I use 15% because that's what I use in my other videos, and I just want to be consistent. I wouldn't be putting all this effort into investment if I was expecting to get less than a 15% return, especially whenever you can just passively invest and get, 10 to 12%. So anyway, all right, so my average price target is $33 a share, and these were some pretty conservative assumptions. So what would my margin of safety here be to buy in? I don't know. Usually I use a margin of safety of 0.67, but man, if I did that, I would only buy it at 22. But that's for like looking at companies that are really undervalued, like great companies that have all these green flags or green sections that I marked over here, great margin, great return on assets, buying back shares. I would use a little bit smaller margin of safety. I don't know. All right, before I tell you what Warren bought it for, you tell me what you would have paid for this. Would you have paid 33? Would you have paid 30? Would you have paid 22? Would you have paid 40? I don't know. Have a number in your head. All right, so here it is. Warren Buffett, accounting for splits, made his investment at $27 a share. So 27 divided by 33, it would have been about 20% off from this. Would I have bought it at that price? I hope so, right? I would like to think so, but investing was like the last thing on my mind in 2016. What would you have done? Comment. If you did buy it, that's even cooler. You can tell your story. But anyway, if you enjoyed the video, please like and subscribe. Check out my channel for more up-to-date videos with real companies that you can go buy today. And I hope you enjoyed it. See you next time.